Hello everyone, my name is Dr. Anshu Sharma. Uh, Today I will take the lecture of capital busting. In earlier session, I have discussed about the capital busting techniques. We have discussed the theory of different capital busting techniques, and today I will discuss the numerical problem. I have discussed accounting, rate of return, payback period, discounted payback period, net present value, profitability index, and IRR. This is the problem number one. In this problem, if we read it, this is consider the following investment opportunity. A machine is available for purchase at a cost of rupees 80,000. It means cost of machinery is rupees 80,000. It is expected to have a life of 5 years and to have a scrap value of rupees 10,000. It means if you are purchasing the machinery at rupees 80,000, its life of the machinery is 5 years, and after 5 years, the machinery is converted into scrap. And whenever you are selling this scrap, it will generate an additional cash flow of rupees 10,000. It is estimated that it will generate additional profit over the life as follows. These estimates of profit are after tax. It means you are purchasing a machinery at a cost of rupees 80,000. After 5 years, you are selling it at rupees 10,000. It is giving the scrap value of rupees 10,000 after 5 years. After that, if you are using this machinery will give you the profit after tax will be as follows: 30,000, 40,000, 30,000, 25,000, 25,000. It will be the profit after tax. And you are required to calculate accounting rate of return. This is the first technique. In last slides, I have discussed, I'm showing you which was the formula. This is accounting rate of return. Accounting rate of return, whenever you have to calculate accounting rate of return, simply you have to find out average profit after tax and you have to find out average investment. Whenever you have to find out average profit, simply you have to add profit of all the years and divide by number of years. Then you will get average profit. And whenever you have to find out the amount of average investment, it will be cost minus scrap value. In the given question, cost of machinery is rupees 80,000. Formula is cost minus scrap value divided by 2 plus scrap value. The cost 80,000, scrap value 10,000, divided by 2 is equal to 35,000. Now let's start the question. So you have to do two things. Number one, you have to find out average profit. If you have to find out average profit, simply you have to add all these figures and you have to divide by 5. Then you can get the figure of average profit. And whenever you have to find out average investment, simply you have to do 80,000 minus 10,000 divided by 2 plus 10,000. Let's start. So the formula of ARR is equal to ARR is equal to average profit divided by average investment into 100. This is the formula of accounting rate of return. Now, first of all, you have to find out the figure of average profit. As I have discussed earlier, whenever you have to find out average profit, what you have to do? Simply you have to add the value of profit of different year. It means average profit is equal to profit of first year, profit of second year, profit of third year, profit of fourth year, plus profit of fifth year. Divide by 5. Now, after that, average investment is equal to cost minus scrap value divided by 2 plus scrap value. So this is the formula, and you have to find out the figure by using these formulas. Now again we come on the question. As I remember, the cost of the machinery is rupees 80,000. So we will write here 80,000 minus step value 10,000 divided by 2 plus 10,000. So plus 10,000. Now it will be 80,000 minus 10,000. 70,000 divided by 2 will be 35,000 plus 10,000. It will be 45,000. This is average investment. Average investment 45,000. Now we have to calculate average profit. Profit of first year, profit of second year, profit of third year, profit of fourth year, profit of fifth year. Now I'm not able to remember the figure, so again we come to the question. Figures are 30, 40 plus 30 plus 25 plus 25. 30, 40, 30, 25, 25. Now profit is equal to average profit is equal to profit of first year, profit of second year, profit of third year, profit of fourth year, and profit of fifth year. Divide by 5. It will be 30 plus 40 plus 30. 1 lakh plus 25 plus 25. 150 by 5. It will be 30,000. This is average profit. Average profit is 30,000, and in last slide I had calculated average investment. It was rupees 45,000 because the formula is cost minus scrap value divided by 2 plus scrap value. It was 80,000 minus 10,000 divided by 2 plus 10,000 is equal to 45,000. This is the average investment. Now, formula of ARR is equal to A RR is equal to average profit divided by average investment into 100. It is 30,000 divided by 45,000 into 100. 66.67%. So you can say the accounting rate of return of the project is around 66.67%. So whenever you have to apply this technique, you have to check if this is a single machinery, then accounting rate of return, if it is generating 66.67% rate, it's much higher rate, machine can be acceptable. And if we are having another alternative, then the machinery which is having better accounting rate of return, or you can say maximum rate, accounting rate of return, will be selected by the organization. This is the question number 1. I'm again summarizing the question. In question, you were given that the organization was purchasing a machinery and the cost of the machinery was ₹80,000 and machine is generating profit after tax of 30,000, 40,000, 30,000, 25,000 and 25,000 in next 5 years. And after completion of 5 years, organization is in position to sell the machinery at ₹10,000. These 3 information was given to you and you have to use it. Whenever you have to apply the technique, you have the formula, simple formula, accounting rate of return. It will be average profit divided by average investment into 100. Then first of all, you have to calculate average profit. Whenever you have to calculate average profit, simply you have to add profit of 5 years divided by 5. If life of the project was 10 years, then you had to sum the profit of 10 years and you had to divide it by 10. So it depends on the life of the machinery or life of the project which you are looking for. And after that, you had to calculate average investment. Simple formula for calculating average investment was cost minus scrap value divided by 2 plus scrap value. There are 2 formulas to calculate average investment. Formula number 1, cost minus scrap value by 2 plus scrap value, and formula number 2 is cost minus scrap value by 2. In formula number 2, we don't add scrap value again. So it depends on you what type of formula you want to use. But there are 2 formulas and both the formulas are used in practice. So simply I calculated the amount by this way: 80,000 minus 10,000 divided by 2 plus 10,000 is equal to 45,000, and put the value in formula, and finally we got the accounting rate of return of the company is 66.67%. We have another problem. There is a difference in this problem and last problem. Figures are almost same. In this question again, a company has an option to purchase a machinery at ₹80,000. Cost is same, just like the last question. Again, company has the choice to sell the machinery at ₹10,000. It means scrap value of the machinery is 10,000, just like in last question. And the profit which is generated by the company are looking same, but figures are not same actually. In last question, these estimates of the profits were after tax. Whenever you have to apply accounting rate of return technique, you have to find out the value of profit after tax. But here, the value which is given to you is not profit after tax. That's a profit before depreciation, interest and tax. It is called PBDIT. profit before depreciation, interest, and tax. So first of all, you have to convert it into profit after tax, and after that you have to apply the formula. Now, let's start. First of all, remember the figures because I have kept in my mind, so I think that you are able to keep in mind also. 30, 40, 30, 25, 25. And here, one more thing which should be given to you. It is expected to have a life of 5 years, have scrap value of 10,000. It is estimated that it will generate additional profit at figures which is given to you. It is PBDIT. Now, whenever you have to convert PBDIT into PAT, you need an amount of depreciation. And the question, the method to calculate depreciation is not given. If the method of calculation of the depreciation is not given the question, we simply assume that the company is using straight line method of depreciation. Straight line method of depreciation, how we can calculate? Simply, first of all, figure of profits. Year 1, year 2, or you can say profit of first year. This is called PBDIT. Here I am writing PBDIT. Here A1, A2, A3, A4, A5. So amount of PBDIT was 30, 40, 30, 25, and 25. This is the expectation of PBDIT, profit before depreciation, interest, and tax. Now let's convert into PBDIT, convert into PAT. So whenever we have to convert it into PAT, we have to follow a format. This is the format. If we deduct the amount of depreciation from PBDIT, the figure which arrives is called PBIT. Less interest, this is PBT. Less tax, this is PAT. And if we add depreciation again, then the figure which we receive is called cash flow after tax. In this question, because we had to calculate accounting rate of return, so we need PAT. But if another question, if you need cash flow after tax and figure which is given to you for PBDIT, then you can convert it adding depreciation in PAT. If you add depreciation in PAT, then the figure which you receive will be cash flow after tax. Now, first of all, you have to find out amount of depreciation. As I have discussed in this problem, the method of charging depreciation was not given. And whenever the method of charging depreciation is not given in the question, we have to assume that the method of depreciation will be straight line method. And whenever we have to apply straight line method, simply we have a simple formula. Depreciation is equal to cost minus scrap value divided by life. Now, if you remember the question, in that question it was given that the cost of the machine is rupees 80,000. 80,000 minus scrap value was 10,000 divided by life. Life was 5 years. So depreciation was rupees 14,000 per year. Now we will write the amount of depreciation every year. 14, 14, 14, 14. If we deduct the amount of depreciation from PBDIT, the figure which arrives is called PBIT, it will be 16,000 for first year. 40,000 minus 14, it will be 26,000 in second year. Again, if we deduct 14,000 from 30,000, it will be 16,000 in third year. It will be 11,000 in fourth year, and again it will be 11,000 in fifth year. This is PBIT. Now, interest is not given in the question, so it will be nil. It means amount of PBT will be same. 16, 26, 16, 11, and 11. Now, in this question, again, tax rate was not given. And if given, if sometime if tax not given the question, we have to assume the tax rate will be 40%. If it is given, it's okay. If not given, we have to assume that tax rate will be 40%. Now, charge tax at the rate of 40%. It will be 6,400, 9,600. It will be 10,400. I think you are able to understand what I am doing. I am charging the amount of tax on profit before tax. If amount of profit before tax is 16,000 and rate of taxation is 40%, it will be 6,400. And if we deduct 6,400 from 16,000, the resultant will be 9,600, and it will be called profit after tax. Again, in second year, the profit before tax is 26,000, and if we deduct tax at the rate of 40%, it will be 10,400, and if we deduct 10,400 from 26,000, it will be 15,600. Now, again, I'm repeating the same thing. In second year, the amount of profit before tax was 26,000, and I charge tax at the rate of 10%, which is around 10,400. If we deduct 10,400 from 26,000, it will be 15,000. It will be 15,600. Again, in third year, 6,400. If we deduct it, it will be 9,600. In fourth year, profit before tax is 11,000, and the amount of tax will be 4,000 400. If deducted, it will be 6,600. And in 5 years, amount of profit will be same, 4,400. It will be 6,600. So this is the amount of profit after tax. Now, we have to calculate average profit. Average profit is equal to profit of first year plus profit of second year plus profit of third year, 6,600 to 6,600 plus 6,600 plus 9,600 plus 15,600 it is 48,000. Divided by 5 is equal to 9,600. This is average profit. Now, we have to calculate average investment. Average investment is equal to cost minus scrap value divided by 2 plus scrap value. Now, cost is 80,000 minus 10,000 divided by 2 plus 10,000. It will be 35,000 plus 10,000, 45,000. Now, simple, we have to apply the formula of ARR. It will be average profit divided by average investment into 100. Average profit 9,600 divided by average investment into 100. Let's calculate. 9,600 divided by 45,000 into 100 will be 21.33%. So now accounting rate of return will be 21.33%. If the same figure is given as a profit before depreciation, interest and tax. As we discussed and we solved the same problem in last slide, and in this slide, this amount was given as a profit after tax. Then the accounting rate of return for the company was 66.67%. And when the figure is given you as a PBDIT, that accounting rate of return is 21.33%. So I think it is clear to all of you. I am repeating again. When I started a question, then I have discussed with you that the information is given you as a PBDIT. So whenever a PBDIT is given to you and you have to calculate accounting rate of return, you have to keep in mind always that you have to convert it into the PAT. And whenever you have to convert into the PAT, you have to follow this structure. First of all, you have to deduct the amount of depreciation. After deducting the amount of depreciation, the figure is PBIT, and from this figure you have to deduct amount of interest. Then the figure which arrives to you is PBT, and after that you have to deduct amount of tax. Then you find out PAT. So we put the values here. First value was given to you, there was no problem. But second, you have to calculate depreciation. And whenever I had to calculate depreciation, I have discussed with you that if it is given in the question that how can you calculate the amount of depreciation, then you have to follow this section. But if it's not given in the question that what is the method, what is the way to calculate the depreciation, you have to follow the straight line method of charging depreciation. So simply I applied this method, straight line method of depreciation. Whenever I have to apply this method, this is the formula to charge the depreciation. This is called cost minus scrap value by life. The cost of machine was rupees 80,000, scrap value is 10,000, and life of 5 years. So depreciation every year which we have to charge on the machine will be 14,000. So I get the amount of depreciation, and finally we come on this figure. After deducting depreciation, we got PBT because interest is nil, and on the amount of PBT we had to charge tax. Again, I discussed with you, if it is given in the question, the amount of charging profit, amount of charging tax on the profit, then you have to follow the section. But if it's not given in the question, you have to assume that the tax rate is 40%, and simply write down whenever you have to solve the question, simply write down that we are assuming the tax rate is 40%, and simply do the answer. So simply I did the same thing. Amount of PBT was 16,000. So I charged depreciation at the rate of 40%. It was 6,400, and simply I deducted 6,400 from 16,000. The figure which I received 9,600 in first year, 15,600 in second year, 9,600 in third year, 6,600 in fourth year, and again 6,600 in fifth year. So these are the amount of profit after tax which is actually we have to receive. Why? Because we have to use the formula, and now we have to put the figures in this formula. We write down the formula AR equal to average profit divided by average investment into 100. Now we had one figure PAT. Now we have to calculate two figures, average profit and average investment. Whenever we had to calculate average profit, simply we sum up all these figures. It means profit of first year, profit of second year, profit of third year, profit of fourth, and profit of fifth year divided by life. And life is 5 years. So 40,000 divided by 5 years is 9,600. And after that, average investment. Again, formula of average investment is cost minus scrap value by 2 plus scrap value. The figure is 45,000. Simply we apply the figures in the formula, and the resultant figure will be 21.33%. So if we are using this approach, the accounting rate of return for the organization is 21.33. I think now it's very much clear to all of you. If it's not clear, then to remove your doubt, I will be available on YouTube, or you can contact me by mail also. Question number 3. Here we have, again we have to calculate average rate of return, and we have to calculate payback period. In last questions, you also have calculate average rate of return, and payback is new for you. First of all, let's read the problem and try to understand. A company is considering an investment proposal to install new mining controls. The project will cost rupees 50,000. The facility has a life expectancy of 5 years and no salvage value. I'm repeating again. Cost of the machinery is 50,000 and life 5 years, no salvage value. The company tax rate is 40%. For usage state land appreciation, estimated PBDIT is given to you. Now, because there are two figures, there are two types of accounting technique we have to apply. First is accounting rate of return, and second one is the payback period. And figures which is given to you is PBDIT. So again, you have to calculate profit after tax to calculate accounting rate of return. And again, you have to calculate cash flow after tax to calculate payback period. These are the profits, and profits are PBDIT. So simply, first of all, you have to convert into PAT. So you have to remember two things. Number one, cost of project 50,000, tax rate is 40%. Cost 50,000, tax rate is 40%. Now let's start the question. Profit are 10, 11, 14. Let's start the question. I have read it earlier. So the figures of PBDIT for 5 years was given PBDIT. Year 1, year 2, year 3, year 4, and year 5. These are the PBDIT. Cost 50,000, scrap value nil, life 5 years, tax 40% or debt, etc. These were the additional information which was given to you in the question. It was given that the PBDIT of 5 years was so and so. Cost of the project was 50,000. Scrap value was nil. Life 5 years. Tax rate 40%. And method of charging the patient will be straight line method. Now let's start the problem. Simply, first of all, you have to convert into a PAT. So this is the format which you have to follow. Amount of depreciation less PBIT less interest, PBT less tax, PAT plus debt. Finally, the figure which we receive is called CFAT. As we know, we have to find out two things here: accounting rate of return and payback period. So whenever we have to calculate accounting rate of return, then we need PAT. But whenever we have to apply payback period, and we had to find out the length. So simply we use first is CFA. Let's start. Depreciation. Amount of depreciation will be cost minus scrap value by life. It will be 50,000 minus nil divided by 5 will be 10,000. 50,000 minus nil divided by 5 is equal to 10,000. 10 nil. 10 1,000. 10,000 4,000. 10 5,000. 10 15,000. Now, interest is nil. So PBT will be again same 1,000, 4,000, 5,000 and 15,000. Now, tax rate is given 40% because profit before tax is nil, so tax will be nil. Now here 400. 600. 2,400. 2. 3,000. 6,000 and 9,000. Because tax rate is 40%, it will be 400. In case of 1,000, it will be 1,600. In case of 4,000, it will be 2,000. In case of 5,000, it will be 6,000. In case of 15,000. Now, you have to add back amount of depreciation. Debt is 10,000. Debt is 10,000. It means it will be 10,600. 10,000. It is 12,400. Now again, this is 10,000. It will be 13,000. Again, this is a 10,000. It will be 19,000. Now, if you have to calculate accounting rate of return, simple, we have calculated earlier in 2 slides. We have solved 2 numericals. So I think it's very much clear to you. You have to add profit of first year, second year, third year, fourth year, and fifth year. And you have to calculate average profit. Average profit is equal to 0 plus 600 plus 2,400, it will be 3,000 plus 3,000 will be 6,000 plus 9,000 will be 15,000 divided by 5. It means 15,000 divided by 5 will be 3,000. Average profit will be 3,000. Now average investment is equal to cost minus scrap value divided by 2 plus scrap value. Cost minus scrap value by 2 plus scrap value. The cost was 50,000, scrap value nil. It means it will be 25,000. Now, ARR is equal to ARR is equal to average profit divided by average investment into 100. Average profit is 3,000. Average investment 25,000 into 100. It will be 12%. If we divide 3,000 by 25,000, it multiplied by 100, then the accounting rate of return will be 12%. So you can say the accounting rate of return of the project is 12%. Now we have to calculate payback period. Now what is the meaning of payback period? Payback period means the length of the duration to recover the investment made by the organization. It means if an organization is purchasing a machine to rupees 50,000, how much time the organization has to spend to recover the cost of the project? Now, to recover the cost, we have to use this CFAT, right? Yes. 1, 2, 3, 4, and 5. They are years. And here we will write cash flow after tax. First year 10,000. Second year 10,600. Third 12,400. 13,000 and 19,000. This is CFAT. Now, in column number 3, you have to write down cumulative cash flow after tax. Cumulative cash flow after tax. Cumulative means simply cumulative value of cash flow after tax in first year is 10,000. In second year, we have to add 10,000 plus 10,600. It will be 20,600. Now, it will be 33,000 in third year. In fourth year, it will be 46, and fifth year, it will be 65,000. Now, you have to find out the actually exact point where we are recovering the investment. If we see the column number 3, it's very much clear that in year 4, we have recovered rupees 46,000 because in first year we received 10,000, in second year we received 10,600, in third year we received 12,400, in fourth year we received 13,000. It means if we accumulate, if we add all these things, it means we have recovered rupees 46,000 in year number 4. Now we have to recover 4,000 additional, but we are receiving rupees 19,000 in fifth year. So it means if we are writing that the payback period of the project is fifth year, it means we have recovered in starting of the fifth year, but we are writing whole 5 years. It may be wrong, so we have to find out the exact point. And whenever we have to find out the exact point, so number one, payback period in this question will be 4 year. Number of year 4 plus 50,000 minus 46,000 divided by 65,000 minus 46,000 into 1, because difference in here will be 1. So here 4 plus 4,000 divided by 19,000. Now let's use the calculator to find out the exact figure. If we divide 4,000 by 19,000, the figure is 0.21. It makes 4 plus 0.21 here, 4 years, 4.21 years. So this is the length of payback period. So you can say to recover the amount of rupees 50,000, company needs 4.21 years. So this is payback period. I think it's clear to all of you. I'm repeating one time again. Simply, you have to do 3 things. First of all, you have to calculate CFAT, and whenever you have to calculate CFAT, most of the time CFAT is directly given to you. But if directly is not given to you, then you have to use a simple structure which I have stated in the last slide, that what is the way to calculate CFAT. PBDIT minus depreciation, then we got PBIT. Now less interest, then we will get PBD, then deduct tax, we will get PAT, and we have to add the depreciation, then we will get tax profit. So simply you have to write down the number of years here. In column number 2, you have to write down the CFAT, and column number 3, you have to write down the cumulative CFAT. And you have to check where we are actually recovering the amount. Here in year number 4, we have received rupees 46,000, but we have to recover, but we are recovering the amount in 5th year. So we are writing the formula, the preceding year 4 plus amount of investment 50,000 minus amount recovered 46,000 by 65 minus 46,000 into 1. Then the amount which we receive, amount means the duration of the project. It is 4.2. So in today's session, we have discussed around 3 problems. I think it will be clear to all of you. In next session, we will discuss another problem on another techniques of capitalism. Thank you very much.